So you were saying something just before, and I told you not to say too much because I thought it could be a good way to start the podcast.
Yeah.
You're working on an article at the moment, or a series of articles?
Well, we're working, a company we covered pretty closely almost exactly this time last year was Blue Sky Alternative Investments, which was a stock market darling until Glaucus, which is a US research group, published a short report and sent the share price tumbling. And on Monday or Tuesday, I think it was Tuesday, they went into receivership. So that is kind of like a big moment that signals the end of Blue Sky. And as reporters, we tend to kind of use that as a marker to look back at what happened and how Blue Sky collapsed. So a few days ago, we kind of retold the story just in a kind of a chronology of how Blue Sky collapsed. But for the weekend, we're looking at all the hedge funds and traders that saw it coming well before it collapsed. What was it about Blue Sky that made them think this was doomed to fail? So that's what we're working on at the moment. There's about 3 or 4 hedge funds that had actually shorted Blue Sky long before Glaucus had published their report. And they actually took a lot of pain. I mean, a lot of them were shorting Blue Sky shares at around $4, $5, $6, $7, $8, went up to about, I think it almost hit $15. So they took a lot of pain. They had total conviction in their position, but that's not enough. They were really hurting. I mean, the position was almost doubling against them. So the article we're working on is A, what made them so convinced that Blue Sky was way overvalued and due for a blow up, and how they managed their position going so much against them when they had conviction in the fundamentals, but the trading was going totally against them. So yeah, that's what we're working on at the moment.
Now, a lot of people who are going to hear this probably aren't familiar with the Blue Sky story, and obviously we can probably dig up a couple of articles of yours and put them in the show notes. But just give us a bit of for some context. What is the Blue Sky story?
Blue Sky is a fund manager, the same way as Magellan or Platinum is a fund manager, but their point of difference was that they were not going to invest in listed equities or traditional asset classes that are easy to access, that mums and dads can almost get access themselves. They were going to focus on private or alternative assets, so things like investing in private equity, so investing in startups, small businesses that they thought were going to grow, property development, so being able to kind of commit capital to a residential property development, commercial property development. And one of their big sleeves was agriculture, water rights, investing in farms. So their pitch to wealthy Australians was, hey, we will get you exposure to this important asset class. It's you can get great returns from it. It's different. You can diversify out of listed equities, bonds, and we'll allow you to do that. So what they did is they created a whole lot of funds, they created a fund, raised the money, and they were effectively unlisted funds. So but they got so good at the marketing that they kept on creating fund after fund after fund after fund. So most private equity funds would raise a whole lot of money and then go and deploy it into anywhere between 5 and 20 companies. But Blue Sky decided, we'll do the Vinomofo fund, we'll do the Shoes of Prey fund, because they just created this conveyor belt of funds, and the funds took huge fees up front and then charged their investors fees over the life of the fund. But because these assets that they invested in were private and there was no real kind of stock market valuation for them, it could be argued, they had a lot of discretion to value those assets, and what those assets kept doing was being valued up. And as they were valued up, they pre-booked the performance fees they were going to earn from when they kind of closed out the fund and returned the money. So what ended up happening was their profits kept going up, even though their cash didn't go up, because, I mean, it was still costing them money to manage the funds. But that was kind of the thesis, is it all kind of relied on the private value of these assets being valued upwards. And that was kind of the big bear case, at least until Glaucus came along, is that this is just kind of, they're marking their own homework, and they effectively have discretion to determine their own profits and their own valuation. And then they went on a fundraising spree. So they just desperately tried to gather as many assets as they could because it just helped with their earnings and helped with their valuation.
Okay, and this Glaucus report, did that mark the top?
The Glaucus, yes, almost. So I think it peaked at the end of, at the start of 2018, and Glaucus came around end of March, early April. So the stock had come off a little bit heading into that, and that's because Blue Sky went out and raised $100 million from the equity market. So literally about 2 weeks before the Glaucus report came out, Blue Sky appointed 2 brokers, raised $100 million. And at the time, a lot of the short sellers that had this thesis that Blue Sky was unsustainable had actually kind of tapped out and exited the trade because they thought, well, look, even if we're right, they have $100 million of cash on their balance sheet so they can plug any holes that could emerge. So I guess the share price came off a little bit because they'd issued more stock and created more supply. So it had kind of come off, but it was still very high. It was in the $12.50 range and it listed in 2012 at $1. So people got very wealthy off it and now it's zero.
Man. Now, you said before that you knew of some hedge funds, about 3 or 4 hedge funds that started shorting the stock around, was it $4 or $5?
Yeah, the big moment for the short sellers, or for the ones that we at least have spoken to either at the time or retrospectively as we've kind of gone to them and asked them about their experience, their big moment was, I think in August 2016, the founder sold about 3.4 million of his 8 odd million shares, and they saw that as a catalyst. They thought, well, and he also stepped off the board, so that means he could sell shares without having to file any or under most conditions he could decrease his holdings without having to
declare
it. Yeah, so they saw that as a big moment. First, him getting out, stepping down, getting out, and stepping off the board. They just the conspiracy theorist short sellers thought, well, this is his opportunity to lighten his position.
Okay. Now, how do you know about the hedge funds that were shorting stock, around $4 or $5? Like, is this sort of part of your role as a journalist that you're out there actively speaking to these fund managers?
Yes, but we don't always know when they're short. Often they will tell you a lot more post the fact. Many years later, they'll tell you that. Often some of them will just tell you what things they see are wrong. Often we would look at a company that is either going up or going down and ring a whole lot of them and ask them what they think's going on, and get their theory and their thesis, and then. But we always follow quite a stringent process. So if someone tells us something, we'll never just kind of put it out there. We'll kind of check with the company, check with long-only investors, and try and triangulate some version of the truth. But I do remember actually not long after Sowerby sold, there were a lot of other hedge funds that were trading that could be either long or short the stock, or just investors that had looked at it and didn't own it and steered clear, but had a lot of theories as to what was driving the share price up. So, yeah, it's a big part of our job is to just talk to all sides. I do like talking to the short sellers because they offer a contrarian view. You always get the long side from the company and from shareholders and from brokers. And actually Blue Sky is a good example of I think what we see a lot, which is a lot of companies that raise a lot of capital aren't necessarily good investments because they're raising capital. I mean, if you're constantly having to dilute your register, go to the market for capital, it's not a hard and fast rule, but it tends to be that a company that needs capital isn't a great company. Like Amazon's a good example of the opposite. It never had to raise $1. It did its IPO and it never went back to the market for capital. But whereas there are companies that are constantly returning to the market to raise new equity, and the irony is those are the companies that the stockbrokers love because they make some money from trading, but they make a bulk of their money from helping companies to raise capital. So it's almost this convenient relationship of if there's a company that raises a lot of capital, the brokers will tend to gravitate towards them. You tend to see very positive research about the company. the stockbrokers are pushing it on their clients. So a Blue Sky, I think, was a good example of that. Very capital hungry company that all the brokers loved, and I think there's probably a few other examples.
Right. And when did you start reporting on the Blue Sky story? Was that after the Glaucus report, or you'd sort of become interested in it beforehand?
Well, I wrote something, I think it was in 2017. So the article's titled "How Bright is the Blue Sky Model?" And I'd summed up some of the short theses that had come out around that time around Sowerby selling his stock. I can think of a handful of people that it raised a red flag for them, and I somehow got in touch with them and put together a thesis. I think it was quite a balanced piece. It was just saying these guys are onto something. There is a huge amount of superannuation money in Australia. Not a lot of it is invested in private markets, and they're offering a solution to that problem or a product that in a market that can grow. So I think it was fairly balanced, but it did raise a lot of questions around their revenue, around their how their profits were kind of growing more than their cash, and how they were how reliant were their profits on fees that they had booked but yet to actually have earned, or yet to have been paid out, because they were earning fees on the value of the assets going up, and that they were booking fees on the value of the assets going up. They hadn't actually been paid those fees. So there was a discrepancy between fees booked in an accounting sense and fees collected. So, but Blue Sky kept going up. So,
yeah, that's incredible that you said there were hedge funds who were shorting it around $5 and it went up to 14. I mean, yeah, like you said, they must have taken a lot of pain on those positions.
Yeah. It is, this is also a very interesting thing. There are a lot of, and there's probably a few examples of, Tesla's actually a terrific example, and there's others. Afterpay is a company a lot of people have shorted. I think the jury's out on that one. Tesla, I think there's a lot of evidence to suggest, and I'm not an expert on Tesla, but it's a similar situation. Tesla has had a lot of short sellers and critics talking it down and suggesting that it's unsustainable. I remember actually having breakfast with a hedge fund manager in I think it would have been 2012 or 13, and it probably was closer to 2013, but Tesla was at $35, and I asked him what he thought about Tesla, because I thought I just met someone that had just started working there, working here in Sydney, helping to kind of build Tesla's profile, and I thought, right. Wow, these cars look quite terrific, and his comment to me was, don't be silly. Every half intelligent investor is shorting Tesla. You should be long Volkswagen, short Tesla. So I don't think that's a trade that worked out. But I guess it just goes to show you that you can be an intelligent, smart, forensic investor, but you can kind of pick the wrong fight. And you can pick something that can either is onto a great trend that defies almost the fundamentals, and they've found a great idea in a great market, and the fundamentals sort themselves out. Or you can be up against extreme hype that, the promoter of the stock can just do a better job of promoting that stock more than kind of the fundamentals catching up. So the lesson from talking to a lot of people that are brave enough to short shares is that it's more than just uncovering problems with the company. You've got to manage a whole lot of other risks.
Yeah, totally. Now you said Blue Sky is it being delisted?
Well, it went into receivership this week, so I think it would be delisted. I think it was at 18 cents when it delisted. The interesting thing is, just over a year ago, it had a very strong balance sheet, had $100 million of cash, minimal debt, and now in May 2019, it's defaulted on a loan, which just shows you how quickly something can unravel.
So what happens to any investors or holders of that stock when it becomes delisted?
I'm not sure. I think I think it's a long process. You're just in line as a creditor. So you have a claim on the assets, and you have to let the receivership process work its way out. And then at some stage in the distant future, I think the receiver will say, you as a equity holder in the business will get X cents in the dollar, and it's most likely to be a zero. I think
Oh, okay.
There'd be a whole lot of lenders that would have claims. So I think I'm not an expert on this. I've seen a few of these situations, but I think you just get in line, and you're actually, as an equity holder, you're at the very back of the line. So,
okay, right. Well, another kind of high profile case which you've covered was Big.
Yep.
And you're quite well known for that. So
Yep.
maybe we should talk about that and maybe go into that.
Sure.
And,
I can talk underwater about Big. It was a real adventure.
Right. Well, I mean, let's just start off by talking about what actually got you interested in Big, and maybe what was the company Big? Like, what did they do?
So before I kind of explain how I got interested, the background on Big. So it was a kind of a micro cap / small cap / mid cap as it was inflating its way up the stock market. I think it was a favorite amongst a lot of small cap investors and retail investors. The business itself made videos for small businesses. So if you were a cafe, Joe's Cafe down the road, someone from Big would at some stage would have given you a call and asked you if you'd be interested in them making a promotional video for you. They'd come and film your cafe and interview you and make a brief 1.5 or 3-minute video about your cafe. They'd produce it for you, and then if you paid them for the video, they would host it on their YouTube channel and help you kind of market your cafe through this video. Their whole thesis was that video was the future of the internet and you needed to get on it. And it was a great way for small businesses to market themselves in the digital age. So,
they'd post the video on their YouTube channel.
Yeah, well, that's kind of the controversial thing. I mean, their pitch was that they had this YouTube channel that had a lot of subscribers, and if they produced a video for you, they would put it on your channel and you would get the benefit of all those YouTube viewers, because they said they had hundreds of thousands of viewers, which I think in hindsight it turned out to be, I think you can buy those viewers at a click farm. So I don't think they were real viewers, but also YouTube is free. So you shouldn't actually, I think it's a breach of the terms of YouTube that a channel can pay you to host.
Okay.
So they had a YouTube channel, and their pitch was that their YouTube channel had a lot of traffic, and they would make the video for you and put it on their YouTube channel and bring a lot of eyeballs to your video and help promote your cafe or your florist or your beautician. So that was what the company did. I mean, the kind of the first discrepancy was they were charging $12,000 to produce the videos, which, we've got a cameraman here. Maybe he can tell us if that's what he's charging you to do this video. He's shaking his head. So, I mean, I think it's somewhere like $300-400 or somewhere in that, maybe either side, depending on the college. So $12,000 is way out of whack, and small businesses are very tight with their dollars. They run tight margins. They've got a lot of costs. They're not going to be blowing $12,000. I mean, that's almost like that pays for a staff member for the full year over to work on a given day over the week. So it was kind of out of whack. And they said they would charge $1,000 a month throughout the year, and not
for
just
hosting the video.
Yeah,
on their
so
YouTube channel.
it would all be kind of in the cost, producing the video and then hosting it over a year and using and running the marketing through the video. So that was the first thing, is that it just seemed like a very expensive product versus what people were willing to pay. And there are a few other red flags. One was the CEO had changed his name and changed it back. And that was actually, we thought we'd struggle to find that, but it was in the prospectus. They were forced to kind of make that disclosure in their prospectus. So we thought we'd have to go to births, deaths, and marriages we were told about this, but it was really just there in the open that the CEO had, for whatever reason, and I think as we kind of explored the story, it became more clear why he may have changed his name and changed it back. The other thing is they said they were making a lot of cash. So this is why the stock market embraced the stock so much, is because every quarter they would put out their 4C and it would show their cash was going up massively. So their cash receipts, so their sales. And a lot of startups say their revenues are going up or their user growth is going up, but it seldom translates into cash. So the more cynical investors out there are focused on cash. I said, if this company is making money, it's should be becoming more valuable. And Big was showing extraordinary growth in cash. I think at one stage they were run rating over a full year $100 million of cash, which is an incredible amount of money. So the stock market was buying the story. But they were not paying their staff, or they were not paying a lot of their costs in cash. So they were making all the cash, but they were choosing instead to pay providers with ultra cheap options, so 20-cent options. When the share price was going from $2 to $4 to $5, they were still paying their staff with these very cheap kind of options to buy stock at 20 cents, which is highly dilutive. And kind of makes no corporate finance sense. If you're generating all this cash, you should have no worries just paying cash rather than almost giving away your company for free, giving away a portion of your company for free. And they were doing this quite systematically. And yeah, that was kind of one of the red flags we had. The other one was that they changed the auditor. They had this auditor for a long time, for about 2 years. They had PKF, which is quite a reputable firm. And they decided to change and hire a single auditor, a single man shop on the other end of the country in WA. And it just didn't seem to make a lot of sense to us why they'd done that. It seemed like a strange move. They said that this auditor had experience with them, but when we looked up the history, all the auditor had done it did a backdated audit of at a period when they'd only operated for a month. So they said this company knew them better, but the existing auditor had a lot more experience with the company. So
are these the things which got you interested in Big, or are these the things which you started to uncover once you started looking into it?
No, all of those things were apparent from the start.
Okay.
So they were all like, that's just kind of like the ground. Those are all the things that didn't make sense to us. But for us, all of that in itself, to me, thought there is something going on here. But the real challenge, and this is kind of why I got so involved in this, is it was a real mystery. It's like, how are they showing all this cash? This is almost something that there's been a whole lot of kind of accounting shenanigans over the years, and most of them are well known to forensic accountants. They can spot things quite easily. They can see, oh, we've seen that before. We saw that with Enron. We saw that with Steinhoff. We saw that with a whole lot of companies. So the good forensic accountants have seen all the tricks on it, but this one was a little different because they were showing all this cash, and you can't fake cash. It's not something you can do. But my suspicion is that they were doing something that was overstating their cash, and it was how am I going to find out what they're doing? And it was quite difficult, and it relied on a lot of luck and a lot of very fortunate tip-offs at fortunate periods. But it was a really kind of fun, exciting, stressful at times journey to find out how are they showing $100 million. How are they showing that they were generating $100 million of cash but not actually generating anything?
So this might be a really naive question,
Sure.
but why is it so difficult to fake how much cash you're holding?
Well, because the auditor has to look at the bank statements. So the auditor has access to the bank statements. So if your bank account says 10 million in June and 20 million in July, $10 million had to have gone into the bank account over that period. So yeah, it's kind of, they're bank statements, and you can track money, and that was the thing, that the money was going into their bank statement, so into their bank account, so that the cash was coming into the business.
Well, I'd love to ask you about how you went on that journey to uncover that cash wasn't, I don't know, was it there or?
Okay, well, I'll try and I could either tell you a 3-hour version or a 10-minute version, or I'll try to do it in even below 10 minutes. Well, the first thing I did, which is similar to what we did on Blue Sky, which is we just wrote a story saying what we know and what we don't know, so we called it Big Un, the most unbelievable stock of the year, because it was actually, in 2017, it was a stock that had done better than any other stock on the whole exchange. It had gone up 5 times, I think, or even more. I think 2,000%. So it had gone from 20 cents to close to $5. So it was the end of the year, and we thought, this is a fair story. How do we explain the best performing stock of the year where investors made 2,000% returns? So we just listed all those kind of red flags that I'd mentioned to you. And said, this is kind of curious, but you know what? The company says they're making money and cash doesn't lie, and left it at that. And it was almost, I was a bit ambitious. We thought we could solve it by just calling up a few good accountants, and someone might be able to pick something up, and we sent the accounts around. No one really picked up anything, so we didn't really solve it. So we just landed up writing, well, these are some of the things that are curious to us. But it acted as a bit of a calling card.
Right.
So there would have been people around the country, or whether they were investors, private investors, whether they were people with some knowledge of how the company worked or some experience with the executives. Some of them got in touch with us, and it was a long process after that of just people coming to us and us taking little bits of information and pulling it all together to work out what was actually going on. I think within a couple of days I think the next day we got a very good tip, which was that we needed to look into this company called Finstro, which is accounting payments company, that Big had partnered with. So the official line is that when we ring up these small businesses, we will cross-sell this Finstro accounts management product where you can factor your invoices, which means they'll help you with your day-to-day financing and your cash flows. Financier, basically. So they said, we need to look into that. And I thought, well, that's really interesting. That means perhaps they are factoring their invoices, which is...
What do you mean by that? What's factoring?
Well, factoring is, if you're a small business, a good example is, so if I was a journalist at a dog food company and we would sell products to Woolworths, and Woolworths would not pay us for 90 days, and we'd have cash flow problems because we'd be sending them all our product and the money was very slow to come back in. So a factoring company will basically pay you 95% of the cash up front and collect the money from Woolworths and make the 5%.
Okay.
So our cash flow problems are solved because our margin is decreased a little bit. But so we thought that Finstro was probably getting the money from the clients and helping their cash look better. So that was our working assumption. It turned out not quite to be the case. But that was an important tip, and we started looking into Finstro and who owned Finstro. It was a Sydney financing company called FC Capital. And so we kind of had a suspicion that they would explain the extraordinary cash growth of the business. But we didn't know exactly what. We just knew it was a good clue because it seemed plausible that these guys were helping. And then we tried, and weeks went by, and I kind of looked at it and dropped it and looked at it, and you can't force issues too much because the information decides when it comes to you. As
Right.
hard as you look, like the key insights don't just happen because you're forcing it. And then a big moment came when Ownership Matters, which is a kind of proxy advice, very good accounting, they're good on accounting and governance. They published a report on the back of the article we wrote to their clients, which just said that the company would actually not be profitable if they reversed how I was explaining about the options, that they would give out cheap shares instead of paying people with cash. So they kind of back-solved that and said, right, well, the real cost they're paying for these expenses, if they were paying and accounting for real expenses, the company arguably wouldn't be making much money. So they were saying, basically they were insinuating that by not paying people with real money and using cheap shares, they are overstating their profits effectively.
These people who they were paying with the options, these weren't employees. These were people who were offering or giving services to
outside consultants, things like that. Yeah. So they said, look, if they were actually paying these people in cash, or sorry, not in cash, but in real money, rather than giving them options that were undervalued and then would appreciate to the current trading price, they arguably weren't profitable. And then they did a whole lot of work around the chairman and come to the conclusion that the chairman was not properly disclosing how much of the company he owned. So that they just did a governance report for their clients and said, look, these are two governance issues. And that for me was like, well, maybe I'll write about that. And while I'm writing about that, I'll go to the company and ask them about their relationship with Finstro, ask them to clear it up. Because we'd also seen a copy of their sales manual that their call center people read out when they try and get a small business to agreed to a video, and we'd seen that there was a lot of reference to, hey, if you sign up now, Finstro, you can get a free line of credit from Finstro and all that stuff. So we thought this is kind of not quite a smoking gun, but it validates our suspicion that the financing company is deeply involved, or more involved than they had cared to admit in the process of selling videos. So we asked the company, we thought, well, we'll ask them about the ownership matters, and then while we're asking them, let's ask them to clear up their relationship with Finstro. And that kind of set off a whole panic. It seemed like it set off a whole panic at the company because they took forever to get back to us. And in the interim, we found out that the financing company had actually been one of the parties that had been issued these ultra cheap shares. So that for us was a significant smoking gun, because it meant that the financing company that was advancing them cash was getting paid in cheap shares that were going up because of the cash that was being advanced to them. If you follow that.
Yeah.
So for us, we thought that was quite scandalous. We wrote about it. And then it was about a week where we thought we'd kind of cracked this case, or at least cracked it open in the public. And we thought that things would come to a head. We'd kind of provided enough evidence that something was not right at this company, and they were not being totally open with their disclosures. But that was when it got really kind of interesting for me, well, in a negative way, because I began to appreciate how many how many mums and dads and punters at home had invested pretty heavily in the stock, and they didn't take kindly to any suggestion that any suggestion other than that big was the future of video and the future of the internet and the next Google. Took a lot of exception, and it was kind of an eye-opener for me, because I'd covered situations like this before with Slater and Gordon and a couple of others where you uncovered something that people were heavily invested in, and you get a lot of negativity and criticism. But this was kind of interesting and on a whole new level. And it was my first experience of it. I think it happens quite a lot now. It's pretty common, and you just need to have thick skin about it. But I was quite amazed at this army of I guess trolls, but trolls I don't hold anything against them, because they've invested a lot of money, they've done their work, they have a lot of faith in the business, they've put a substantial portion of their position in this company, so it's understandable that they'd be upset and angry. And
so how were they getting in contact with you?
Oh, Twitter, yeah.
Oh, Twitter.
Yeah, so
okay.
I mean, I didn't get too upset about it, but it was quite relentless and quite scary at times. Yeah, it was just it's a new thing, I guess, that journalists these days have to deal with, especially if they're trying to uncover things that are unkosher. I guess you've just got to be prepared for this. Maybe I was slightly prepared, but not totally prepared for it. And you just got to, I think in the past, if this was 10 years ago, the editor would get 2 angry letters, of which one he might pass to me, and I would just crumple it up and throw it in the bin. But now you're getting like an army of people. So the big accusation against me was that I was working for short sellers, that a whole lot of people had shorted the shares, and I'd shorted the shares myself, and I was now basically putting out this ownership matters. It was the theory that they'd shorted the shares. So there was a conspiracy theory that ownership matters, and a whole bunch of evil dark hedge funds were making money off my reporting. And they'd found that some CFD report, which showed that volumes went up on the Friday before my article, or the Monday, I can't remember exactly. And yeah, for a few weeks, I just got these constant accusations that I was, and that ASIC was investigating, and
you didn't have a position?
No, absolutely not.
Let's just clear that up.
No, absolutely not. And actually, when I started writing about the stock, the person that first kind of alerted me to this said, "Look, this is actually a stock that is almost impossible to short. It is not a lot of borrow, which means not a lot of stock available to be sold short, because it was tightly held by retail investors, and you could short some through in CFDs, but it was very insignificant." So I remember hearing that and thinking, great, this is one where I don't have to be accused of.
Yeah. Okay. So why was it so difficult to short that stock?
I think there just wasn't much shares available to borrow. So I think the only shares available to borrow were from people that had bought big through contracts for difference, and the contracts for difference provider would allow someone to take the other side of that long position. So
Yeah.
if you'd bought big through a CFD, you'd have a CFD position, a derivative position in big. And I think they would allow someone to take the other side of that trade.
Gotcha.
But most people were buying it on the stock market, not through CFDs.
Yeah. Now, I wanted to ask you just before, like through this process up to this point, how much had you actually been talking to Big, the company? Like, would you try and speak with them? Were they willing
that
to
was the
speak
other
with you?
accusation that I never. Well, yeah, we before we wrote anything, we would. So when I did that article at the start of the year, we had a lot of detailed, sent them a lot of detailed questions, got a lot of detailed responses, incorporated it all into the article. I think they were quite grateful for that. And then throughout that, I would email them everything I was going to write about the company. I would email them. So every day almost. For the first two, until they stopped even acknowledging receipt of the emails. So after about 2 weeks, I just stopped bothering that. I think I even sent them an email and said, look, given you're not responding, I'm not going to seek your comment anymore. So
Okay.
they had opportunities to, I think they were speaking through other people, through proxies on social media.
Right. What do you mean by that? They had alias accounts and...
Oh, I think there were some holders that seemed to be saying things that sounded like it would have come from the company. I don't know that for sure, but I got that impression.
Okay.
So I think I was sort of getting their view across to me. But no, the thing about at the paper, we always try. We have a no surprises policy. We don't want anyone, good or bad, to wake up in the morning and open the paper and be shocked to see them being accused of something or being suggested they've done something without the questions having gone to them. So, right. I think it's a good policy. It's right, but also we don't want to be wrong. So if there's some little thing we've missed and we send it to the company or to the person and they say, "Oh, you're totally wrong. Let me show you this document," or "Let me point you to this part of the accounts," and you go, "Oh, yeah, sorry."
Yeah, because your reputation's on the
totally,
line, right?
Absolutely, yeah. I think that's absolutely integral. Is often suggestions we're just trying to get clickbait, but it's not true. Like our overriding priority is our reputation, the credibility of the paper, credibility of the reporter. That overrides any desire for obviously we want to write great stories and we want as many people to read them as possible, but overriding is our credibility. So we wouldn't risk it for an incremental fact or accusation or anything like that.
Yeah. Now, I don't know if I missed this just before or a little bit earlier, but I don't know that you explained how they were actually sort of fudging that $100 million of cash.
Yep. Okay, there's a little bit before that, but it's probably not as interesting. So ultimately what we finally determined, and we got a tip-off that someone sent us a shot of an invoice and said, look, this small business, let's call them Jack's Cafe, this is an internal photo of their of their computer, and it shows that this Jack Joe's has been invoiced $12,000 internally. So in Big's accounts, there's $12,000 that this customer has agreed to pay, and they've been invoiced. But they said, go and ring Joe's and you'll find out that it's not the case. It was actually a beautician, and I harassed this poor lady for 5 days just to get her. I just wanted her to say, hey, can you just confirm that you've never used this service before? And she said, yes, they even called me on Friday. They want me to sign up, and I refused to sign up. They made a video for free and I hated it. So I don't want anything I keep telling them, thanks, but no thanks. I'm like, well, that's interesting because they've invoiced you $12,000. Internally, they've booked you as they've achieved a $12,000 sale. So I thought that must be what's going on everywhere.
But they never sent the invoice to her.
No.
Okay.
What eventually came out after we... Oh, the other interesting thing, actually, as an aside, is they had $30 million of cash on their balance sheet. So all this cash was coming in, was staying in Big's balance sheet. So they actually had a mountain of money. So that was the other thing we had to solve. Like, if that money, how do we explain that $30 million of cash? What I did find out is that, And I was at dinner with a friend who's a very good accountant, and I was not tossing and turning, and like it was really bugging me that we hadn't really been able to solve this. And I pulled out the accounts over dinner, and he scrolled through and he goes, "Oh, as an auditor, one of the tests we do is a interest test, which is we look at the interest income on the profit and loss, how much interest the company's made over a period, and we look at that as a percentage of their balance of cash. So if you have $1 million of cash, you should get something close to 2%. Because if you have all that money, you're going to make sure that you earn an appropriate return on it.
Right.
It's a meaningful. The 2, 3, 4, 5% deposit rate matters a lot when your balance is very large. So you'd expect that to be in a high interest earning, or at least a moderately interest earning account. And we quickly did the maths on that, and it was very low. It was like $10,000. So like you'd earn that in an afternoon.
So where did you see that $10,000?
That was just taking the $30 million of cash, $30 million of cash, and comparing that to the interest.
So that $10, that $10,000 that was on sort of
over like 6 months or something like that. Yeah,
that was, you saw that from
on the accounts. Yeah.
Yeah, so that was from an announcement.
There was the published accounts. I think either their full year or the half year accounts. Okay. I don't remember. Yeah. So it was their audited accounts, and it just showed
they released to the market.
Yeah. It just showed that they actually were not making any interest on this $30 million of cash.
That's very interesting.
So what I did the next day is there's something called a PPSI register, which is every time you lend money that is secured against an asset, that asset effectively is registered. The lender registers that asset. So if you have a Toyota, a lease, like a car lease, Toyota there'll be a record that that their asset is secured. Toyota has a claim on that asset. So we did a search the next day, and I'd done this before, but I did it on Big Un, not Big Review TV, which is the operating company.
Okay.
And we found that FC Capital, the financing company, had security over all of Big Review TV's assets. So, which meant that they had security over the cash, which meant the cash was theirs, effectively. They had control over their $30 million of cash.
What do you mean by they had control over it?
It
was theirs?
It was theirs, yeah, basically. To dumb down the language, it was theirs. It was in a trust account that they had control over. So,
so that money hadn't come from video sales.
It had gone through Big. It had gone into Big's accounts, into a cash account, but that FC Capital controlled. So FC basically still had access to the money or control over the money. So that was a big red flag for it. I mean, that was a big kind of smoking gun. It just meant that all the cash that was going into Big didn't actually belong to them in a full sense. FC Capital had total security over it. Then what came out not long after that is they finally revealed what they were doing, which is that every time they would make an invoice, every time they would do a free video, they would write an invoice, and about some of that would go to Big so that they could manage their expenses and pay for their video guys and stuff like that. So they operate. So I think out of every 12 grand, maybe 3 grand would go to Big so that they could use in a working capital account. I think something like 5 grand or 6 grand would go into this trust account, which Big couldn't really touch. And the difference would go back to FC Capital Finance Company as a commission.
Okay.
And if the customer decided a few days later that he wasn't interested in the video, all Big had to do was find a new customer to replace that contract. Mm-hmm. So they just had to find, instead of Joe's Cafe, they had to find Jack's Cafe, and they could drop Jack in where Joe was, and life goes on. So it was just a money merry-go-round, really, and it was fooling the market because the cash was going into the company looking like cash, but it wasn't. It was either being held there for safekeeping by the financing company, and the rest was going back to them as a commission. And FC Capital, the financing company, was getting shares at a deep discount. So they were benefiting from the process of the money going into the company, inflating the valuation of the shares they were being given. So that's how they did it. That's kind of how they faked the cash. They just came up with a very convoluted, uneconomical arrangement with a cooperative financing company that was prepared to push money through the company. So it gave the impression that they were generating a lot of cash.
So what do you think was the motivation of the management at Big? Like, do you feel as though they set out with the intentions of, I guess, committing financial, it was fraud, right?
Yeah, I'm always reluctant to use the F word because,
Okay.
yeah.
Okay, well, let's not use that word, but let's say, did they set out, did they have intentions of doing things which were a little bit sketchy?
Well, I think they listed in 2014 and the share price went nowhere, just kind of bumbled along at 20 cents a share and they struggling. And then I think when I wrote about a big sum up story to explain how it all happened, there was a moment, I think, when they figured something out and they all got very excited and they raised some money and they all got very excited and the CEO was kind of came up with all these like payment plans. Like you could tell something was, they were on the cusp of something. And then this happened, and then they changed auditors. They came up with these started issuing all these options. So I think at some stage they figured out a way to do this, or they figured out this financing arrangement, and they probably, I think my suspicion is some people told them, look, if you can convince the market that you can generate cash, the market will reward you, and your share prices will go up. So
you think they were aware that what they were doing could be deceiving to investors?
Well, unless they're accidental geniuses, unless they kind of like, unless they genuinely thought that this convoluted financing arrangement where the money goes in and it gets held in account and kicks back as a commission, which kind of makes very little practical sense, unless they genuinely thought that was the best way to run their business and they just accidentally got the benefit of the market thinking they were making a lot of money. Eventually they restated their accounts, and after our coverage, they were forced to restate their accounts. It took them a very, very long time, I think over a year. And what they put out just showed the total opposite of how they represented. They were losing money, they were unprofitable, they were deeply in debt. It was a complete mess. So, I think it's just, to me, it's pretty blatant.
So when you were doing, when you were reporting on this and when you were writing about it, how much thought went into about like how you were, like when you would release articles, or was it just as new information came, or did you was it a planned kind of
No, it wasn't planned. No, it wasn't planned. It's just as the information came, and we benefited from help of a lot of whistleblowers, so we were getting a lot of good information. But I mean, for me, one of the big moments was when we thought we'd kind of cracked it. This was before we'd got the invoice, the fake invoice. We thought we'd cracked it, and we went to the ASX because they had their half-year results, and just chatting to someone there and about all the issues in the market, and they said, "Oh well, yeah, we don't think this is as egregious as you think, Jonathan." And that was a terrifying moment for me, because I was like, "Oh my Lord, like." People don't think there's anything wrong with this. They think this can all be explained with a few little disclosure fixes.
It was terrifying because people weren't aware what was going on, or you might have been wrong.
Yeah,
on this.
People that mattered, so Exchange didn't seem too fussed about it.
Okay.
I was really taken aback by that.
And you felt as though they should have been given things you had pointed out.
I don't think they saw what I saw, which was bleedingly obvious, is that something was going on here. And that was terrifying. I was terrified because I walked out thinking, my Lord, if I don't solve this again, like what I'd done up to that point wasn't enough. If I don't do it again, if I don't go all the way, like I've carried the ball 60 meters, I actually have to put it over the touchline, take the ball, and then kick it through the goals for people to actually appreciate what's going on. And I wasn't sure I'd be able to get there. I wasn't really sure I'd go the extra 40 yards. I didn't have the information at hand. I had to go out and gather it. And It was actually really difficult, and I was very fortunate to get that extra information. It relied on whistleblowers coming forward with extremely invaluable information, and then a few key insights like that accounting, like working out the cash on the interest cover, which was kind of unfortunate that I knew someone that was so good at accounts, but serendipitous that I'd sat down with them and they'd kind of picked that up as an issue. So it Big could very easily have remained uncovered for many years. I think it was in the process of being added to the small cap index, which would have given it legitimized it, would have put BlackRock and Vanguard would have piled into the register. People would have piled out. Small caps would have just a lot of fund managers would probably just bought it just because they don't want to manage their tracking error against the index. They would have had a whole lot of dumb money would have come into it, and life would have gone on. And sometime in the long future, something would have come out. The share price might have fallen, but yeah, it was almost like Scooby-Doo style. I would have got away with it.
Right. So, what was the sort of the outcome of Big? Now, like nowadays, it doesn't exist.
Yeah, it went into administration. It was a messy process, but it's gone into administration. Shareholders have lost all their money. And the ASX, we were quite critical of the ASX but to be fair to them, they explained their position on it. I think they have actually toughened up a lot on the smaller end of town. I think the same way papers were about their credibility. I think the ASX probably felt they were doing the right thing and they were monitoring things correctly. I'm not suggesting they weren't, but I think after that, and I don't know if Big was a catalyst, but the sense is they've gotten a lot tougher. They scrutinise announcements a lot more. And I think the market's better for it. I think they just don't want to have another one of these situations again. So we've seen and noticed, and some people even think they've become too tough. But I think rather be too tough than not tough enough.
Mm. Is there any way that you can sort of measure the impact or the cost that this had on investors?
Well, look, once it went into administration, I did ring a whole lot of investors, some of them that sent me emails kind of making polite accusations, but I didn't mind that. I think, again, I totally understand where these people are coming from, and just explained to them, they thought I was very unfair to the company. They thought I was making light of a lot of things, which I do not believe for a second. I took everything very, very seriously. And a lot of colleagues of mine are very professional and seen this before, and always over my shoulder saying, look, don't get carried away on this. There are people don't get carried away about how absurd this is and what they're doing. Like, there are people with money, life savings invested in this company, and just you need to be sensitive. You need to be mindful and sensitive of them. And I think I always was. And when it did collapse, I did ring a whole lot of these investors and said, look, just do you want to share anonymously? So I wrote an article where I couldn't quote anyone by name because they just didn't want to be named. And there were some really sad stories of people pensioners that didn't have a lot of pensioners might have decent sized balances, but they feel every loss because they aren't going to be working again. So the money they have is the money they have forever. So they feel every dollar they lose hurts them way more than it hurts anybody that has an income and can earn that dollar back. And there was someone that had saved like hundreds of thousands of dollars for a house, who was going to get married, lost it all, lost a big chunk of his money in Big. And it's really sad. I mean, when I wrote that article, people kind of got a good feedback, but there were other people, and I don't disagree with them, saying, well, these people need to understand their risk better. Like, why on earth have you got all this money in one position, a speculative position at that? And I think I agree. I think if there's a lesson from Big for retail investors, no matter how good the story is and no matter how mispriced an asset is, you've got to discount the fact that you could be 100% wrong, and it's not going to blow you up. So yeah, I mean that's a lesson for Big. I don't think, but I think some people learn it, but there's always a conveyor belt of new fools that come and haven't learned that lesson and lose all their money, and they wiser for it, but they poorer for it, and then they disappear, and then a new breed of people that can be convinced by riches kind of fall into the same trap. So people learn, but it's different people learning at different times.
Yeah.
So
No, I mean, I think you said that very well. And you won some awards, or an award for this story, didn't you? Or this series?
Yeah, Walkley in last year, which was pretty cool. Yeah. I'm glad.
Well done,
it was nice because there were all these people that helped me in the background that I couldn't name them, but it was good for them because they'd be able to feel some sense of that they contributed to something that was recognized. So, I mean, I'm lucky I get my byline on there so people know I wrote the story and get congratulated. But there's kind of made me think about all those people that helped me. There were at least half a dozen that were invaluable, but there were probably a dozen that were valuable. And a lot of them, I don't even know their names. They're still anonymous to me, but
Right.
feel quite close to them because I had a lot of interactions with them. And then there's probably a handful of people, two in particular, that aren't anonymous. Well, I know them very well, but they have busy day jobs and plenty to do, but they invested a lot of time to help me, I think because they're just helpful people and they had the knowledge and the intellect of solving these things. And I think a lot of them just don't like these things. Like when they see something that's wrong in finance, where people are being taken advantage of, or the system's being abused, the accounting rules are being abused, the market's being abused, they take it they get fired up, and they will spend those 3 hours every night kind of helping me. And actually, the thing is, people think a lot of people in finance are greedy, but that's not true. There's a tiny sliver that are ultra greedy, I think, and most people are good people, and they just want the system. They just want the system to be as fair as possible, and hate manipulation of prices and of accounts, and so that's actually kind of what keeps the paper going. I think what keeps me going is all this silent army of people that want to make sure that everyone is kept honest.
Yeah. Actually, something I did want to ask you,
Sure.
I guess, in regards to this is, obviously the information that you release and publish has great impact on the stock price. Or
Sometimes,
can do,
yeah.
Depend, in this case, 100%.
Yeah.
Are there any kind of regulations that you've got to abide by, or is there any sort of governance over that?
Yeah, well, yeah. There's a code of conduct that everyone at the paper, it's part of our employment, and it's been a while since I've read it, but generally the reporters are ethical. They know what their responsibilities are. They know what's appropriate, what's not appropriate, and managing conflicts is kind of important. Again, it goes to our credibility. Look, if I was trading something, I would never in a million years consider it. But if I was, it wouldn't be hard for someone to go onto a share register and see my name there, or someone to complain to ASIC, and ASIC just makes one call to some brokerage firm and sees my name there. And it'd probably be more likely to be like a company. Let's say I was spruiking a company and I had shares, or then someone found my name there. There's information is out there. So I think reporters know their responsibilities very well, and they're not there to. I can't think of any reporter that's in this industry or in this profession to try and scalp a few dollars here and there. Like we're all about, and we're holding people to account. So why would we? If we're holding people vigorously to account, it'd be very hypocritical of us to do otherwise.
How do you feel about the activist short sellers and the sort of the short hedge funds and that, who will take a significant short position in a company and then release a hit piece on them? Like, how do you feel about the ethics of that?
It's an interesting question. I don't know. I'm kind of divided on it. Like, my view is there's short selling and there's market manipulation, and you need to totally separate those two things. They are completely opposite. They don't go hand in hand. I mean, they are two different things. There's manipulation, market manipulation of a stock up or down, and there's activism long and short. So whenever there's market manipulation, I think that's wrong. I think if you're manipulating something on the short side, that's wrong. But if you're manipulating it on the short side, on the long side, that's wrong too. Short selling, I think, is really important. Has a really important role. But I guess the information has to be right, and I think short sellers also live and die by their credibility. So if they put out reports that are not credible, over time they will lose their impact. So they have an interest to make sure that whatever they're putting out is credible. I think we've seen some kind of copycat activist shorts. I think the company was Credit Corp on the ASX. Yeah. And we took one look at that. Everyone took one look at that and go, this is just amateur hour. And I don't think it impacted the stock at all. In terms of, I think the way where there's a very grey area, and I don't know the answer to this, but I think is interesting is like the timing of issues. You know, like if people are taking a position and then the report comes out, you know, obviously like Glaucus, I think they were quite open. We took a position and then we put out our report and we made money from that. Mm-hmm. Then their credibility matters whether they're right or wrong. If they're wrong, then they can rightly be accused of just doing a kind of a hit job, you know, to drive the price down. But if they're right, then it's hard to argue too much about that. What is interesting is then if other people are aware of the report coming out, I think these guys do, the credible ones go to great lengths to make sure that they're not telling the world that they're about to put out a report, and they, just to protect their own reputation, I think they keep it secret, the timing of their reports. But you know what's interesting, and we're seeing this in the UK and Germany with Wirecard. I don't know if you followed that situation. So Wirecard was the subject of a lot of activist shorting. The Financial Times has also done a lot of very good detailed reporting on it. But the FT is being accused of, by German regulators, which they stringently deny, of I think, and I might get this wrong, but broadly my understanding is they're being accused of making people aware of when their news reports are coming out. So they've said that people have been aware that the FT will publish something on the Friday. Now that's an interesting one, because as a reporter, I think it is difficult to manage that. I think it's important you don't say when you're going to publish something, but if you've rung someone for a bit of information or to check a fact or to get their view on some accounting or something like that, then someone might be able to work out, oh, well, they're on the verge of writing a report. So it's a bit like ASIC. Let's say ASIC goes around and interviews a whole lot of traders, and those traders might know, hey, ASIC's looking into this issue, you know, and they're going to put out a report, and maybe I should short that industry or something like that. So it's a difficult one. And I think, I don't know what I think any manipulation is bad. Any kind of trading on that front, it's not right. I think good ethical people know what's right and wrong. Good ethical reporters know what's right and wrong. And
no, I think
it's a tricky one.
It
is a tricky one.
Yeah. Now, obviously, we've spent the majority of the time here speaking about Beg, and we spoke about Blue Sky a little bit at the beginning. There's also been a bunch of other cases that you've worked on. You mentioned it before, Slater and Gordon.
Yeah.
Get Swift.
Get Swift was more my colleagues, so I was just in the background cheering them on. But
right.
That was I didn't have anything to do with Get Swift other than piping in with a few comments there. But that was a very interesting one as well.
Has there been, you know, as a reporter, obviously you get sort of highly recognised for certain things, and there's probably some things which don't get as much attention, which you're quite proud of. You know, like I do some podcasts which I think are awesome podcasts, but they're maybe not as popular as some of the ones which get a lot of traction.
Totally, yeah. No, I get that. There's a lot of that. I feel a lot of that at times. Yeah, yeah.
Are there any examples of that which stand out, or anything on the top of your mind?
Well, I tell you what. One article that I keep referring to, it's got nothing to do with finance, but it's like really stuck in my head. And like every time I watch sport, it sticks with me, and it's totally changed the way I watch sport. I interviewed this former Wallaby called Ben Darwin.
Okay.
He'd actually be good on the podcast. I reckon people would listen to it. He's a former Wallaby, and he went into data. He accidentally fell into data science, and he's come up with this whole theory, which ever since he's told it to me, I see it in play, which is cohesion and teamwork, which is the more a team is together, the more team is assembled and plays together and reinforces each other, the more successful they are, the more they understand each other. He studied the Crusaders, and he said they all came from the same high school. So by the time they played for the Wallabies, they're all very cohesive and well integrated. And he's maybe I can send you the link so your readers can see. But and I'm an Arsenal fan of English football, and I remember a couple of years ago he told me Spurs and Liverpool would be the top teams in England because they were the most cohesive and they had built their whole club around. The directors had a vision of the club and building it from the ground up and making sure that it was sustainable and not just over investing in talent that wasn't sustainable for short-term fixes. And he was right. I think Liverpool and Spurs, unfortunately, as an Arsenal fan, are playing in the Champions League. So there's things like that I like when I'm often writing negative stories and takedowns. Not often, but that's a big focus. And it's nice to be able to identify, and this is something you do way more than I do, is identify these great intellects and talents and insightful people and draw it out of them. So every time I do that, kind of offsets the fact that I've caused trouble somewhere. I feel like maybe they can keep the universe in zen. When I interview a very good fund manager and he rings me up and he said, we got a call from so-and-so on the back of your article and they're interested in investing in us and things like that. That's when I kind of like those articles.
Okay. Yeah, cool. Yeah, I'll make sure to grab that link from you and I'll put that in the show notes.
Yeah, I think he's been right. And I think he applied it to finance, Ben Dolan, and he said, look, a company, it's so important to have a good board of directors governing it from the top with a long-term view that's more important than the coach or the players. It's the board. It all stems from governance. And yeah, you see it a lot. You see like the best teams are the ones and the best organizations are the ones that have a good culture and it's set from the top and they're not trying to get somewhere too quickly. They're trying to build something. So.
Yeah. Okay. What are your thoughts? I don't know if you'll have what sort of answer you'll give on this, but what are your thoughts on the current state of financial journalism? You know, you've been doing this for, is it about 10 years now?
Yeah. I think it's healthy. I really do believe it. Like from the paper's point of view, I think almost 10 years at the AFI, I've begun to appreciate, I think as valued as brands like the AFI, I think they're almost undervalued as to these long-serving mastheads because we've got a brand, so we've got tens of thousands of readers. So we have reach, which means people have to take us seriously when we ask them questions. We've got lots of experienced journalists. We all gather together in one place every day or online every day and can share information. So I'll know tons of people and then my colleague will know tons of people. And so we can, like a real node of information. We've got access to a whole lot of things. We've got legal support, which allows us to push stories further than other people might. Tons of resources. So I think like that, and we are unbiased effectively. We're not pushing any agenda. We're just out looking for good stories and information. Like we're trying to address that information asymmetry that's out there, you know, where someone knows a lot. And so like that's where we, so I think the thing I've come to appreciate is just the power of a very well-resourced brand with credibility and reach. And I think whether I'm there or like it's like me driving a car. If I leave, I think someone else would come in and drive it I'd like to think almost equally well, probably better. So I just think, and that's something why I always don't get too carried away with my own abilities, because I think 90% of what I do is just the fact that I'm in the right seat at the right organization with the right reach. So it's just like have all the tools and do you use them well? And I think there's tons of people at the paper that use them. I guess my overall point is it's the AFR that's really kind of it's the brand that's allowed these stories to get written more so than me. I think I'm kind of just in the cockpit and I didn't design the plane. But I think we're like one thing that's changed is there's a lot more voices out there. Social media is a good and bad. I think overall it's a good if you want the truth. The problem is there's just more information out there, almost too much. But if you know who's credible, it's up to us journalists to kind of, there's so many voices in the blogosphere, of which some are extremely intelligent and valuable and find things out. And it's kind of, I feel like our role in this new age is to find the good ones and screen out the bad ones and use the information they provide us to take it to the next level, whether it's they've given us a tip and we can get it all the way, or we can take what they've discovered and broadcast it to a wider audience. So I think what worries me a little bit is that there are platforms where they aren't as credible, I think. I'm not saying they aren't as credible as I don't think they're governed well. And I just worry that the wrong information is getting to a lot of people, and there's this whole, don't believe the mainstream media, or, that worries me a little bit. I mean, we're not perfect in mainstream media. We do get things wrong, but we have good process and credibility and brand and access, and almost all the time, I believe we're on the money, or we've at least done what we can to make sure that we're writing is true. So my one concern is that I just hope that we can't. I think we're doing well in this age, and we'll continue to do well in this age, and we're benefiting from a diversity of voices. I think, like, I learn so much from podcasts that have no affiliation to any brand. The content is terrific, and that's good. I think more information is better. I don't think anyone should try to have a monopoly on good info. So it's good. I just do worry that sometimes people with self-interest might be able to use this new digital social media age to kind of attract attract people to their schemes.
Yeah, I know what you're saying. I know exactly what you're saying.
Yeah.
Cool. All right, Jonathan, well, let's leave it there. Let's call this a wrap.
Sure.
If someone wants to follow you, I know you're pretty active, or reasonably active, on Twitter.
Yeah.
Yeah?
Johnny Shap, JOHNNYSHAP.
Okay.
But read the AFI, I reckon, is your first port of call.
If someone wants to specifically find your articles on AFR, is there a way to do that? Like, is there an author page?
Just my articles. If you can go on my Twitter, there's like a link just to the Twitter bio, just the ones I've written. But yeah,
okay.
But there's plenty of other good articles in the AFR. So
great, and I'll put a bunch of links from different things we've referenced throughout this in the show notes. Now, if someone's listening to this episode on YouTube, just an FYI, go to chatwithtraders.com/the episode number. So these links won't be in YouTube. They'll be on the Chat with Traders website. Anyway, just throwing that out there. All right, Jonathan, well, I really appreciate you taking the time to do this and, allowing us to come in here, and
absolute
it's been a
pleasure.
great conversation. So thank you.
No worries. My pleasure. Thanks.